To sell the house or not to sell? Hey there, I'm Cameron Young, certified financial planner, and today I'm going to be answering your burning questions about retirement. Let's jump right into it. Left Lane Cap asks, retiring in 2055, how much will you need? Honestly, I think this is a great question, and truthfully, there really isn't a magic number that you want to get to retire, say, 30 years down the road. There's a ton of variables that go into a question like this. Number one is going to be, what do you want retirement to look like? And obviously that can be pretty tough to project 30 years out. But basing around kind of, your budget today or what you think you'll want to be spending in retirement and the activities you would do, it's a pretty good starting point, because then from there you can work backwards and actually figure out, okay, if I want to travel once a year, it's going to cost me roughly, in today's dollars is the best way to do these calculations, that trip's going to cost me $10,000. Maybe I'm currently spending 60 grand a year, so maybe budget for $70,000 a year. Then you can kind of do the math and work backwards and say, okay, what does that actually look like, inflation adjusted 30 years down the line? The biggest issue with these types of things is we don't know what the economic landscape will look like. We don't know what returns in the market will have been over the past 30 years. We don't know if inflation will have stayed kind of around the historical rates that we've seen. So, the numbers that you put together today probably won't be applicable 30 years down the road. And that's one of the big things of working with a financial planner, especially for a long-term engagement, is making sure that you are constantly updating that plan, right? Every single year, check in. How have my investments grown? How's kind of inflation going? Have retirement plans changed? Does my career trajectory change? There's so many different things that go into this. Something else that a lot of people don't really think about when talking about retirement planning, even as far out as 2055, is doing something that's known as a Monte Carlo simulation. And especially what that is you're doing, let's say, 1,000 different simulations of possible events that could happen come retirement. So you get kind of your average scenario where the market gives you average returns, it's been kind of up and down, your spending is on average, you're kind of, what you would expect scenario. But you also want to look at the worst case scenarios, which are a big part of these Monte Carlo simulations. And the worst case scenario is a good example would be, let's say you retire and immediately the next day after you retire, the market crashes and drops 30-40% in value. Maybe you have a relatively resilient portfolio and maybe you only drop 15 to 20%. But could your portfolio now handle retirement with such a big drop and you're forced to draw from it, right? It's a good question to ask, and these types of simulations are something we specialize in and think that it's very important in retirement planning. So overall, the long answer to a short question is, how much will you need is going to be very dependent on what you do, kind of what your retirement goals are, but you should always be working with a financial planner to help them do that math on your behalf. Great question though. Let's hop on to the next one. Retire Logica asks, to sell the house or not to sell? Now, this is a great question, especially in retirement, and there's pros and cons to both, truthfully. For a lot of Canadians out there, you might have most of your net worth and equity built up in your home itself. And really the only way to access it, besides taking out debt against the property, would be to sell the place. The biggest question that follows that, however, is, well, and where the heck do you go? You still need housing afterwards. That could mean renting, right? And renting has its own benefits. Renting essentially sets a ceiling on how much you will ever spend on your housing costs, where, as you know, as a homeowner, your mortgage payment is essentially the minimum amount you pay for your housing costs. There's going to be property taxes, there's going to be other expenses, maybe your AC breaks, your fridge goes, whatever it is that way. So renting is, especially if you can find rent at a place you like for a reasonable value, it's a pretty good way of capping your housing expenses that way. Now, the only issue is the older you get in retirement, the harder it is to kind of do things like your landlord's renovating or your landlord wants to sell a place and now you're getting evicted and you have to move somewhere else, right? Like when you're 30, 40, 50 years old, you can handle these things and having to find a new rental property. But the older you get, the harder it is to do those things. Like if you're 75, 80 years old and you're basically being evicted from your place because the landlord wants to sell it, that's not an ideal scenario. And then the question is, where do you go after that? So there are pros and cons to having a house. Obviously, having that place that you kind of grow old in, there's a draw to that as well. But for some Canadians, the retirement plan has been the equity they put into their house. Their house is now worth $1 million. They paid their mortgage off, but maybe they didn't save a ton into TFSAs and RSPs. Well, you don't really have much of a choice besides either taking debt out against the property, or the other option would be you sell, invest the proceeds, and rent that way. For everyone, each individual is going to have a different scenario, and the best thing you can do is work with your financial planner to kind of understand the implications of selling your house and really talk with your, if it's yourself or your significant other, about where do we go once we sell, right? Are we downsizing? Is downsizing going to be into a house that we like? Plenty of questions, and obviously it's a conversation that we all should be having, especially as Canadians here, where a lot of our net worth is built into real estate. That's a great question though. Let's hop on to the next one. Wolf Hunter asks, how much is needed to retire in Canada? So this is a bit of an interesting one because you get this question very often of how much money do I need? And you'll get all sorts of these different numbers. You need 500,000, you need 750, you need $1 million to retire here in Canada. And none of those are the correct answer, because the correct answer really depends on what your lifestyle looks like. For someone, if they have extremely high spending habits, you might need $2 or $3 million, right? Really what you should be doing is figuring out how much am I actually going to be spending, and then work backwards from there. Let's say you spend $10,000 a month, and that is your current lifestyle. That's what you want to do in retirement. It's kind of the life that you want to keep living. So from there, you would figure out, okay, if I need 120 grand of after-tax money in my bank account every single year, you would do the math and figure out, okay, what investment balance does that work out to? What kind of rate of return do I need? Kind of run through those Monte Carlo simulations to say, if things don't go as planned, is this still enough to kind of keep living that retirement lifestyle that I'm accustomed to? And these are all really good questions that you should be working with your financial planner on. It's nothing that there is a magic number, right? Obviously, the number one goal is going to be continue to save, pay yourself, right? Your future self will be thanking you down the line. Any amount truly will work, but you should really be working with a financial planner that can do the math for you and help figure out some of those more exact numbers. If you're spending $6 grand a month, your financial planner can solve that math for you and say, with inflation, with, the Monte Carlo simulation to see what happens if things don't go to plan, with a conservative rate of return, all these different factors that kind of go into play, they can solve for you and say, here is the number that you should be shooting for. It doesn't mean that you need to hit that number on the marker. Obviously, if you're at 2.5 million of your 3 million goal, it's not that you can't retire. You just might need to A, adjust what retirement looks like for you, or B, understand that you're taking on a little bit more risk if the markets don't kind of react favorably, if inflation is higher than, kind of expected, all these little things that could throw your plan off that way. But it's a really good question, and work with your financial planner to kind of understand what that magic number for you actually is. Let's hop on to the next one. Huey Bluey asks, was the cost of a financial retirement planner worth it? And this is really talking about fee-for-service or fee-only financial planners. And it's an interesting question that we get very often. So the draw of working with a fee-only or fee-for-service financial planner is that you should be getting unbiased, impartial advice that is simply the facts and the figures and the raw numbers based on your situation. You're essentially coming to the planner with a problem, and they are the one that is going to provide a solution. And that problem might be, do I have enough to retire? That problem might be, how do I manage taxes in retirement? And the fee-for-service planner, a good one at least, will draft a plan for you, kind of break down the implications of kind of option A, B, C. What are the impacts, strategies you should probably consider, things along those lines that way. And then typically you'll work on a few different engagement models. One could be just a flat rate fee. They're going to charge X amount of dollars to put this plan together, typically depending on the scope of the work. And the other option being an hourly rate. So they will tell you, okay, I'm looking for, as a random number, $100 an hour, right, to put this plan together. They tell you it's a 20-hour project to put your plan together, meet with you, the whole 9 yards that way. You pay the bill accordingly there. So the real question being that kind of cost benefit analysis, is that cost worth it? Number one is, are you working with a quality financial planner? Because if you pay someone $2,000 and they don't give you $2,000 worth of work, right, you're not finding the value in it that way. Obviously, the short answer is no. But if you have a planner that's coming to the table with tax strategies that might save you $20,000, $30,000 in retirement, typically speaking, yes, that cost will be worth it for you that way. The biggest thing with working for a fee-for-service planner and not, for example, a holistic wealth management model where your wealth advisor kind of does everything for you, including the financial planning, is you are the one that is responsible for executing the plan, right? If you want the financial planner to do everything for you, rebalance your portfolio, well, you're better off just working with both a financial planner and a wealth manager, kind of, the wealth management experience that way. But typically with fee-for-service planning, they're providing you with this completed plan, and it's up to you to execute it, right? So if they tell you, here's your tax withdrawal strategy in retirement, here's the best way to deregister your assets in the most tax efficient way possible, it's completely up to you to execute it. And if you don't execute it, in the proper way, or you don't follow it to a T, once again, you might find that spending that money wasn't worth it, but it's not so much the planner's fault. It's more so the fact that the onus is on you that way. Typically speaking, I would say if you're working with a quality planner, the fee typically is worth it, given that you have a scenario where, you do need good quality advice that way. Let me know in the comments below if you ever paid for a financial planning service and what were your experiences. I'd love to hear more. Hops to Guy 1 asks, are there disadvantages to converting your RSP to a RIF? And in this specific scenario, it's more so converting before 65 years of age. So interestingly enough, 65 is not even really the typical age where a lot of Canadians convert their RSPs into RIFs. Typically, it coincides with you retire at 65, your RSPs roll into RIFs that way, but you actually don't have to convert it till 71 years of age. And there can be benefits to delaying it. There can also be, pros to doing it early, and really it's going to be every scenario is different. But the biggest disadvantage to converting an RSP into a RIF early, especially if you don't need the income, is the fact that you are now mandated by the government every single year to take out a prescribed amount from that RIF. Essentially what I mean is if you have a $100,000 RSP, you're 60 years of age, you convert it into a RIF, the government is essentially going to say, well, now based off of your age, every year, here is the minimum amount that you need to take out for this. Well, why does that matter? Let's say you decide to go back to work and now your taxable income level has shot up. Well, now you have this RIF that you're forced to take additional income from, and RIF income basically just counts the exact same as employment income does. It's 100% taxable. So from a tax treatment standpoint, this can actually kind of screw you over. It's one of those things where when you're doing the conversion, you need to make sure that A, you're going to withdraw from the RIF. There's purpose kind of behind it that way. And B, there's not any sort of other sources of income where maybe delaying the RIF would make kind of more sense that way, especially when, age 71 as the example is kind of the furthest you can push it. A good example might be, okay, let's say I have non-registered assets that I can draw from first. Could be a good idea to kind of get rid of some of those to kind of mitigate long-term capital gains. You pay interest on taxes on the interest and the dividends and everything like that every single year. So maybe it's not worth, in this scenario, converting your RSP into a RIF right away. You draw down the non-registered assets first, and then you can kind of kick the RSP in later down the road. Lets it grow a little bit more that way without having to take these kind of forced withdrawals out for you there. Something to note is at age 65, Canadians actually do get access to a small pension tax credit. It's not a ton of money, but essentially a chunk of the RIF money that you take out. Typically, the number you would take out is $2,000 a year. Of course, this number could change at any time with the CRA, but you would take out $2,000 in RIF income. This is actually part of this tax credit where you can get a little bit of money back for that RIF income. So that could be a reason at age 65 to start doing so. But really, at the end of the day, you should be consulting with a financial planner to really understand your tax situation and understand which accounts are the best ones to pull from. Because maybe it does make sense to convert your RSP to a RIF at age 60 if there are income needs. But in your situation, maybe there could be a better route first. You should really consult with a financial planner first and foremost. But truthfully, it's a great question, and there is no yes or no answer to it that way. Those were all great questions. If any of you would like me to actually do a Monte Carlo simulation in depth, please feel free to put your kind of situation information down in the comments below. And in a future video, we can go through that together and see how it works out. Take care.